Good evening, everybody. I'm Bill Griffith. Tyler is off tonight.
And I'm Susie Garib. Good evening from me as well. Well, you may not know it by looking out your window or at the calendar, but the all-important spring housing season has already begun. And today we got conflicting and divergent signals about the direction of the U.S. housing market. Sales of new homes in January unexpectedly shot up by nearly 10%, reaching the fastest sales pace in 5 years. At the same time, mortgage applications last week fell almost 9%. That's the lowest level in 2 decades. So how do investors make sense of the data? Which way is housing headed? And what does it mean for home buyers and sellers? Diana Olick reports.
It was last spring in an interview on CNBC that housing guru Ivy Zelman uttered these fateful words.
I think we're in nirvana for housing.
Now, after a sharp turnaround in sales of both new and existing homes, Zelman explained her thinking.
I think nirvana took a pause. During that time, home prices were surging, and we had very attractive affordability. And a few months after I was on, we had rates spike about 100+ basis points, and we saw a pause. The consumer was rationally responding to the surge in prices, the backup in rates.
New reports this week show home prices were up over 11% in 2013 from 2012. That and higher mortgage rates are making housing a far more expensive proposition today than just a year ago. While buying is still 38% cheaper than renting, according to a new report from Trulia, that is down from 44% cheaper a year ago.
It's still very cheap to buy compared to rent, mostly because mortgage rates are still very low by historical standards. They're up over the last year, but mortgage rates at 4.5 would be the envy of anyone coming to us today from the 2000s or the 90s or the 80s.
Mortgage applications to buy a home fell last week to their lowest level in nearly 2 decades. But Zelman is not concerned. She says credit is loosening and spring will be stronger.
I think we're going to see things rip when we see the weather thaw and the consumers are coming out, and there's not enough supply.
That supply was eaten up by investors in 2013, and investors may now be turning their sights on new construction. Zelman says it's still a small slice of the market, but she doesn't dismiss the potential. Some large-scale investors are already buying new homes, able to rent them for far higher returns. That new cash could change the landscape for the nation's still beleaguered builders. For Nightly Business Report, I'm Diana Olick.
Carl Riccadonna joins us now to discuss his outlook for the housing market. Carl is senior economist at Deutsche Bank. Good evening, Carl. What do you make of the conflicting data on housing? Are we in recovery or not?
I think we are definitely in recovery, but we have to be very disciplined at this time of year because this is the low season for the housing market. Activity is typically about 40% higher during those peak selling months of March, April, May, June, and July. So what we're looking at now is really just a trickle of data, a trickle of transactions, and it can really be distorted by things like the inclement weather that's been impacting much of the eastern half of the country for really from December into January and again into February. So I'm trying to stand back and not really cast judgment until we get a better look at things in a few months' time.
That makes a lot of sense, Carl, but when you look at the information we have now, as Diana was just reporting, you know, that there's not much supply of homes on the market. And then on top of that, we see that mortgage rates are notching up. You know, it's 4% for a 30-year. Not bad, but they are notching up. Does this keep home buyers away?
I don't think this keeps home buyers away at all. And in fact, if we said 2013 was the nirvana year for the housing market, I think 2014 might be nirvana squared. I think the rate of construction in the GDP accounts will double this year compared to what we saw last year. I think home price appreciation is going to continue. Affordability, while down a bit from where we were in the last couple of years, which is no surprise given that mortgage rates are higher and housing is a bit more expensive, affordability is still at record high levels, going from 1971 when the data began all the way up to 2007. We are still higher now relative to that period. And even if we have a further back up in interest rates, let's say a 1% increase in mortgage rates this year, affordability will still be higher than at any point during that period.
You anticipated my question. I know it's a mug's game to forecast interest rates, but with the Fed tapering, presumably eventually long interest rates, which dictate mortgage rates, will be rising. So how much higher do you think we could see a mortgage rate be by the end of this year, and why doesn't that mean less affordability?
Well, it's all in relative terms. So absolutely, I think mortgage rates will back up. Let's look at the 10-year Treasury note, for instance, which a lot of mortgages are based off of. Our view is that the 10-year Treasury yield could increase by easily 1 percentage point, if not more, by year end. So we're looking at a 4% 10-year Treasury compared to now where we're maybe 275 or so. So significant room for backup. The same thing will happen to mortgage rates. So on the margin, yes, that makes housing less affordable. But affordability is a 3-variable equation. It matters where home prices are, where mortgage rates are, and also where household income growth is. And if we have a year where the labor market finally turns over, and I think it's going to be one of those years, that's going to provide a solid support to household income creation, and it's going to enable the average household to continue to be active in the real estate market.
Carl, there's always this debate about buy versus rent. A lot of people got turned away from the whole concept, the American dream of owning your own home because of this latest financial crisis. What about now? What do you see the trend? And what does that mean for the economy if more people rent rather than buy?
Well, I don't think it's a case of once bitten, twice shy with respect to the housing market. Just as people didn't pull away from stocks after the bubble in the late 90s and early 2000s, I think people are going to be very active in re-entering the real estate market. What's interesting, though, there's a shortage on both fronts. So there's a shortage of rental units. There's also a shortage of homes for sale, either newly built ones or resales. So we have an inventory shortage on both fronts, and that means that we'll see more rental inflation as the rental vacancy rate is back at 2001, 2002 levels. It also means that we'll see price appreciation in the housing sector. For both newly built homes and resales, we were up about 12% in home prices last year. Right. Given the lean inventory and ongoing increase in sales, I'm hinting of an inventory sales ratio, that tells us that home price appreciation should be up probably 8 to 10% in 2014.
All right. A bullish housing forecast from Carl Riccadonna, the senior economist at Deutsche Bank. Good to see you, Carl. Thanks.
Thank you.